My name is Alan Ellman. I'm president of the Blue Collar Investor Corp. And welcome to everybody here in San Francisco and everybody watching this seminar live around the world. Appreciate your attendance. We're going to talk about a strategy that I've been using now for about 25 years, selling options, specifically covered call writing. But then we're going to take it a step further, and we're going to show you how we could use this strategy for very blue chip, safe, cash-rich companies like stocks in the Dow 30 and in the S&P 500. So the presentation will start with the foundations of options and covered call writing. It'll include a few definitions. And once we have that foundation, then we'll apply covered call writing specifically to blue chip stocks in the S&P 500 and in the Dow 30. So our goals when we use these strategies basically is to generate monthly cash flow, something that I've been doing now for, like I said, 25 years. We're going to focus in on Dow 30 stocks and S&P 500 stocks because there are a lot of investors out there that want to generate cash flow, are willing to settle for very significant but not the highest kind of returns that I get when I trade, for example, growth companies, but elite performing growth companies. So we're going to craft covered call writing specifically to very conservative investors that are looking to beat the market every single year. Let's start off with some basic definitions. I know some of you know these terms already. Some of you are relatively new to options. There are only a handful of definitions. So let's start off with the very, very basic one. What is an option? Well, it's a contract that gives the holder or buyer of that contract the right but not the obligation to buy or sell 100 shares of stock. So if we're going to buy or sell a call option, we must first own 100 shares of the underlying security, be it a stock or an exchange-traded fund. Now, a call option specifically gives the holder or buyer of that contract the right to buy 100 shares. And a put option gives the holder the right to sell 100 shares. Today we're going to focus in on selling call options, covered call writing. So we are selling some unknown person the right but not the obligation to buy our shares from us at a price that we determine, that's called the strike price, by a date that we determine, that's known as the expiration date, and most options expire on the third Friday of the month, 4 p.m. Eastern Time. I want to talk to you about a very important concept, and these definitions relate to the moneyness of call options, the relationship between the strike price, the price we're willing to sell our shares for, as it relates to the current market value of the stock. And we have 4 definitions. 2 of them are very closely related. We're going to start out with the out-of-the-money strike. Now, that's the most popular, by far, of all the options covered call writers do. And that's where the strike price is higher than the current market value. We have a stock at 28. We sell the $30 call option. That $30 strike is known as out of the money, or higher than current market value. The next definition is at the money. And that's where the strike price and the current market value of the stock are the same. So you buy a stock for 30 and agree to sell it for 30. That's at the money, and yes, we get paid for that. Now, closely related to at the money, you may hear the term near the money. Now, near the money is when the price of the stock and the strike price are almost the same, but maybe off by some pennies. So an example would be if we bought a stock for $29.95 and sold the $30 strike, well, technically that 30 strike is out of the money, higher than current market value, but it's so close that most options traders will reference it as near the money. And finally, the strike that almost no covered call writers use, hopefully I can convince you to use it when it's appropriate, is the in the money strike. And that's where we agree to sell our shares for a lower price than current market value. Example, stock is trading at 32 here, and we agree to sell it for 30 here. Well, why the heck would we do that? The answer is the premium that we're going to generate when we sell that $30 call option is going to compensate us for the $2 that we're going to lose on the sale of the stock, plus a little bit more. And it's that little bit more that represents our actual initial profit. So I'm going to be breaking this down for you in the upcoming slides. But for right now, keep in mind the in-the-money strike, lower than current market value, is the one that we're going to use in bear and volatile markets. Kind of what we have right now with concerns about the China trade war, with the inverted yield curve. This is an appropriate time to consider using the in-the-money strike. Now let's talk about the option premium as it relates to the stock price. So when we receive a premium, when we sell that call option, we kind of go on our computer, buy stock, click, now we own the stock, sell option, click, and the cash comes into our account. That premium consists of intrinsic value plus time value. Now, here's the tricky part. Intrinsic value applies only to an in-the-money strike. So if we sold an at-the-money strike, buy a stock at 30, sell the 30 call, or an out-of-the-money strike, buy a stock at 28, sell the 30 call, there is no intrinsic value component to that premium. However, if we sold an in-the-money strike, buy a stock at 32, sell the 30 call, lower than current market value, and we received a premium of $3, we can't count that entire $3 as profit because we're losing $2 on the sale of the stock. So our actual initial time value profit in that scenario is $1. That is known as time value. The $2 that we can't count as profit is known as intrinsic value. So intrinsic value is the amount that the strike price is lower than the current market value of the stock. You're going to see some slides with the Ellman calculator that'll break this all down for you. So we're going to now take this into a couple more definitions, the Dow 30 and the S&P 500, and then we're going to actually show you how to generate a constant monthly stream of cash by selling options against these blue chip stocks. So the Dow Jones Industrial Average, you've all heard it. Turn on Bloomberg, CNBC, any financial network. The Dow is up 100, it's down 60, it's this, it's that, because it represents a gauge of the health of the market. Now, years ago, everybody focused in on the Dow, and that became the market. But nowadays, it's more the S&P 500 that's considered the market because it's a broader look. It's 500 stocks compared to 30. So when people reference the market, generally they're referencing the S&P 500 because it's 500 of the largest corporations in the United States. Now I want to tell you about another definition here, the select sector spiders. Now these are exchange-traded funds. Let me define that for you. An exchange-traded fund or an ETF is like a mutual fund except that it behaves as a stock. So you can buy and sell it during the course of a trading day, and many of them have options associated with them. So when you buy one share of an ETF, you're buying a whole basket of stocks, and then you could write options against those stocks. Now, generally speaking, the premium that you're going to receive when you sell an option against an ETF is going to be lower than that of an individual stock. I'm talking in general terms now. Because within that basket of stocks, some are going up, some are going down. So when you take the security in its entirety, it has less implied volatility than an individual stock. But it is a great way to diversify, and it's a very conservative approach to covered call writing. Now, the way we analyze it for our members is we do a 3-month chart of various select sector spiders, and we take the ones that are the best performing. So the select sector spiders divide the S&P 500 into 11 different sectors or 11 different categories. About a year ago, there were only 9 of them. They added 2 more over the last year. So now, if we, for example, took the 3 best performing select sector spiders, in essence, you have shares in the top, let's say, 27, 28% of the S&P 500, as opposed to buying the whole index where you have the good, the bad, and the ugly. So if you want to sell options against S&P 500 stocks, this is a fantastic way to do it. Analyze what's going on today with these select sector spiders. Pick the best performing ones. That means the institutional traders are favoring these particular sectors. So I'm talking about now mutual funds, hedge funds, banks, insurance companies, the guys that move the market, not people like us. So by selecting the top 3 or 4 or 2, whatever your portfolio allows for, you have the best performers at that point in time, and you could change it around every single month because I favor 1-month options. So here's a look at the 11 select sector spiders. You can see the various categories up on the screenshot there. The ones that were added recently were XLC at the bottom for communications and XLRE real estate. So those were added within the last year. So once again, if you pick 3 of them, you're in the top 28% of the S&P 500. Don't you think that's better than being in the entire index? So now let's get back to our definition of covered call writing. 3 terms, covered call writing. Covered means we know our cost basis. We are protected. When we sell the option, if we didn't first own the shares, we'd be using what's called a naked option, a very risky strategy. So we don't want to incur risk. If you're here for a covered call writing presentation, chances are you're a conservative investor looking to beat the market, willing to take on a certain amount of risk, but not a whole lot of risk. So you're not going to want to sell naked options. You buy the stock, you know your cost basis. So the first step in covered call writing is to buy the stock or ETF. Now that we own the stock and we know and we are covered or protected, we're now free to sell the option. We're selling the call option. So covered, we're protected. Call tells us the type of option we're selling. We are selling some unknown person, that guy over there, we don't even know who it is, the right but not the obligation to buy our shares from us at the strike price that we determine by the expiration date that we determine. In return for undertaking this obligation, we are paid a cash premium that's dictated by the market. Now, the third word in the term covered call writing, writing means we're initiating the trade, we're opening the trade. If you go into your brokerage account, buy stock, boom, 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 click, we own the stock. Sell call option, it's called sell to open, STO. So we're initiating the trade, we're opening the trade by selling the option. So it's an open position in your brokerage account. It will look like you've lost that amount of money because it's still an open position. In fact, the cash goes into your account in seconds. Boom, sell the call option, the cash is now in your account. So that's what the 3 words within covered call writing represent. Now, I'm here to tell you, or maybe let's say to ask you, not to consider covered call writing until you've mastered these 3 required skills. Number 1, what stock or ETF should we use before we sell the option? A lot of retail investors make a very common mistake, and that is they'll look for a stock that generates the highest return. Now, the good news is you do get, for a very, very volatile stock, a very juicy option premium. You could get 10, 12% a month. The bad news is you're incurring a lot of risk because volatile stocks go like this. They go up and down significantly. So you have more risk to the downside when you have a highly volatile stock. So you should not select your stocks based on the option premium. It's a very common mistake. So I'm hoping that none of you in the audience here or at home make that mistake. Now, how do we select the stock? Well, today we're talking about S&P 500 and Dow 30 stocks, so we know we're dealing with very good companies, and I'll show you how we screen those. But generally speaking, I have a 3-pronged approach. I do a fundamental analysis, a technical analysis, and I use certain common sense principles like minimum trading volume and avoiding earnings reports, things of that nature. We'll talk a little bit about that today as well. The second skill is option selection. How do we know what option to select? Well, we have to determine the moneyness of the strike. We're going to go with an out-of-the-money strike in a bullish market with good chart technicals. We're going to go, and an example we gave before, buy a stock at 28, sell the 30 call. Now, why would we do that in a bull market? Because it gives us the opportunity for two income streams in the same month with the same cash. Now, an in-the-money strike has that intrinsic value component I talked to you about before, which means the premium is going to be larger for an in-the-money strike. So our break-even is lower. So it gives us protection. The in-the-money strike is the one we should use in a bear or volatile market like we have right now. And position management, this is where most covered call writers fall short. They know how to buy a stock, know how to sell an option, but have no clue what to do if the trade turns against you or ends up way better than you anticipated. If there's an ex-dividend date, how does that impact the trade? How do earnings reports? What if the strike is in the money? You don't want to sell your shares. There are things that we have to know before we enter the trade so that we don't come to a point where we go, uh-oh, stock price went down, what do I do now? Or, uh-oh, the stock price went up $15, what does that mean? Am I losing money? You don't want your share sold. So there are a myriad of factors. Easy to learn. Won't take that long. But this is what you have to come prepared for before you generate that premium selling an option. You get that instant gratification. Buy stock, boom, sell option. Wow, $450 in my account. I love it. But then if this trade starts turning direction, you must know what to do. So these are the three required skills. The average retail investor that knows little or nothing about covered call writing will need about 3 to 4 months to actually get going, where they can feel comfortable and confident that they could manage their trades. So, I could do a presentation and people could say to me, hopefully, hey, you did a pretty good job today. I think I'm going to go write some covered calls on Monday. No. You need to take your time to educate yourself, paper trade for a month or two, start off conservatively, and then, ladies and gentlemen, you have years and decades to benefit from this great strategy. Here's a preview example of how covered call writing works. And by the way, at the end of the presentation, I'll take questions, so I appreciate hanging off until then. And even after the presentation ends and the live part ends, I'll hang around if you need me to answer questions. So keep them in mind or jot them down if anything comes up while I'm speaking. Preview example for covered call writing. I told you 100 shares of stock. So we're going to buy 100 shares of company XYZ at 48. Our cost basis is $4,800. I'm leaving out small trading commissions, which will make the math a little uncomfortable for all of us. Now, we're in that covered position, protected. We sell the call option. So we're selling that guy over there the right but not the obligation to buy our shares from us at a price that we determine, let's say $50, out of the money, higher than current market value of the stock, at any time over the next 1 month. All right? Now, I love monthly options. That's where I've had my success. There are a lot of members of the blue-collar investor that like weeklies. You can make a lot of money with weeklies, too. My sweet spot is monthlies. So you're going to see monthly charts here. Okay, a typical premium would be $1.50 or $150 for the contract. Now, at that point in time, $150 profit on a cost basis of $4,800 represents a 3.1% initial 1-month return. If we could do that every month, it annualizes out to 37%. But this doesn't mean that's where we're going to end up at the end of the month. Could be lower, could be higher. You have to know how to manage a trade. At the end of the month, there are two possible major outcomes. Let's assume for a moment that the price of XYZ never supersedes the $50 strike. Buy at 48, sell at 50. It never goes higher than that 50 strike. Let's say it stays at 48. Okay? Well, that guy over there is not going to go, I got an idea. I'm going to exercise my option and buy Allen shares for 50, even though they're trading at market for 48. Not happening. So the option expires worthless. We keep the $150. We keep that no matter what. We still own the shares, and now we're free to sell another option the next month against the same stock. The profit was 3.1% for the 1 month. Now, the other possibility is the price of the stock does, in fact, go higher than the strike price. Buy at 48, sell the 50 call, 52. Now, that guy over there is going to go, wow, I'm going to exercise my option, buy the stock from Allen at 50, and sell it at market for 52 and make a nice profit. But we're the option sellers. So let's have a look at this trade now through our eyes. We made 150 on the sale of the option. Now we've made 200 on the sale of the stock. 48 to 50 times 100. Total profit, 350. That represents a 7.3% 1 month return and annualizes out to that ridiculous number at the bottom of the screenshot, 87%. So let me stop and state the obvious, something you already know. You're not going to get this kind of return on every position in your portfolio every month of the year. You already know that. However, in normal and bull market conditions, you're going to see a few of these. Folks, I've been doing this for 25 years. Every month, I get a few of these. So you have to know when to use that type of strike, the out-of-the-money strike. When do you use that, and when do you use the in-the-money strike? That's part of the option selection skill set. So the general screening process, I told you, was fundamental analysis, earnings and revenues. I use a few IBD screens. It's all in my material. If you want a question in Q&A, I'll be happy to answer it for you. We use technical analysis, reading a price chart. Very intimidating the first time you try to read a price chart, but the fact remains is that if you could tell if a line is going up or down, or if it's above or below zero, you could read a price chart. Now, understanding why that is significant is another story. But I use 4 parameters for my technical analysis where I've had a lot of success relating to covered call writing. I use exponential moving averages, 20 and 100 day. And then I use a momentum indicators called the MACD histogram and stochastic oscillator. Don't worry about these terms if you've never heard them before. Basically, is the line going up? Is it going down? Is it above zero? Is it below zero? That's it. And if something, and then I look at volume. So if something is looking bullish on a chart, I'm more likely to sell the out-of-the-money strike. If it's looking mixed on a chart, I'm more likely to sell an in-the-money strike. If it's negative, all negative, the stock gets thrown the heck out of my portfolio or I never buy it to begin with. So technical analysis, then common sense principles like minimum trading volume, 250,000 shares per day is what I use for my growth stocks. Proper diversification, asset allocation, those type of things. And the most important one is never, ever, ever sell an option if there's an upcoming earnings report. It's way too risky. I got bopped over the head too many times early on in the 90s when I started teaching myself these strategies with disappointing earnings reports. We don't need that headache. So never sell an option if the earnings report's prior to contract expiration. Now this is just a screenshot of the report that we provide to our members, and the top blue row over there are all the parameters that I just talked about. The fundamental analysis, I use IBD screens, the 4 technical indicators I just mentioned to you, and the common sense principles like minimum trading volume. So the stocks are all screened, and they have to pass all those screens, otherwise they don't make our eligible list. And the ones that you see in gold are the ones that are reporting earnings that contract month. So it's like we let our members know, be careful. Even though these stocks passed our screens, they're not eligible until the earnings report passes. The ones in the white cells are all eligible. And then we also show our members every week during that contract which stocks were on the list, which got moved off, and so they could see like the strength of each stock every week of that contract. Okay, so that's that's an overview of covered call writing. Obviously, there's more to it than what I can say in a 45-minute presentation, but that's a general idea of how it works. And now let's move it on to the Dow 30 screening. So we're looking for Dow 30 stocks that outperform the S&P 500 over 2 time frames, a 3-month time frame and a 1-year time frame. So if there's a stock in the Dow 30 that's beating the market in the last 3 months and in the last year, it's showing some pretty good strength overall. So we do a technical chart of those 2 time frames. We're also going to avoid earnings reports. We always avoid earnings reports no matter what we're selling options against. Whether it's calls or puts, whether it's S&P, growth stocks, whatever, we always avoid earnings reports. And if you don't want your shares taken from you, if let's say maybe you're trading in a taxable account and you have stocks that are of a low cost basis, you don't want to sell them, you also have to watch out for ex-dividend dates. And the reason for that is options early assignment is extremely, extremely rare. But when it happens when there's a dividend involved. When that guy over there gets the big idea to exercise the option, buy our shares from us in order to capture our dividend, right? So it's rare even with ex-dividend dates. But the date that we have to worry about is the ex-dividend date, not the distribution date. So is it possible our shares will be called away early? Yes. The chances are tiny. Maybe it's happened to me 5 times in 25 years of trading. And I could care less if they take my shares from me to capture a dividend. I really could care less because the dividend dwarfs in comparison to the money I'm making selling options. And actually, I look at it as a positive because I'm maximizing my trade and I'm getting the money back early in that same contract, and I might be able to use that cash to then sell another option on a different stock. So I'm actually happy about it. But there are some people that don't want to sell their shares. So I'm here to tell you, and I'm thinking very deeply now, when early exercise will happen, if it happens. And the answer is the day before the ex-dividend date. So you should never have an option in place the day prior to the ex-dividend date if you are very intent on holding on to your shares, because that's when early exercise may occur. Now, how do you know when the ex-dividend date is? There are a lot of good free sites. The one that we use for our members is dividendinvestor.com, and that will tell you when the ex-date is for that particular security. I told you before, never ever sell an option on a stock that's reporting earnings prior to contract expiration. But if it's a stock you love, maybe it's Apple, you've made so much money on it, you want to keep it, fine. Write the option after the report passes. Okay, you could still write the option, but wait for the report to pass, and then write the option. You can also use weeklies. Most of these blue chip companies have weekly options associated with them. Those are options that expire every week on Friday, every single week. So if let's say it's a 4-week contract and the ex-dividend date or the earnings report is the 3rd week, here's what you do. Sell weekly, don't sell anything. Sell weekly, come back and sell monthlies again. So that's how you circumnavigate around ex-dates and earnings reports. Now, I told you that if early exercise is going to occur, it's the ex-dividend, it's the day before the ex-date. So what you do is, this isn't rocket science, what you do is wait for the ex-date or the next day, and that's when you sell your option. But let's say there aren't weeklies, and the ex-date is later in a monthly contract, and if you wait for the ex-date, you haven't really made any time value that month. What do you do? Well, what you do in a case like that is, let's say it's January, right? And the ex-date in February is well into the contract. Skip over February and sell the March. It's the only time I recommend more than a 1-month contract. Skip February, go into March, move contract expiration very far away from the ex-dividend date, and chances are so small that the retail investor is going to exercise to capture that dividend. So Either wait for the X date or the next day if it's early in the contract, or sell a 2-month option the previous month if it's later in the contract. Here's how we screen the Dow 30 stocks. Now, you could see these are the stocks that have beaten the S&P 500 in both time frames, 3 months and 1 year. Now, if we're looking at Visa at the bottom, you could see in the last 3 months, Visa was up 1%. Visa has been on our list for a long time. It's made a ton of money for our members. It's been a really solid company for a long, long time. Just pull up a price chart on Visa. In the last year, Visa was up 18% compared to -1 on the 3-month S&P and +2 on the 1 year on the S&P. So that's what all the stocks that you see in this list now have beaten the S&P in both of those time frames. So those are eligible. Now, a lot of people say, yeah, but can you make any money on Dow 30 stocks? I don't think so, because they're blue chip stocks. They don't move that much. They're not volatile. All right, let's wait, let's see. What I did was I looked at out-of-the-money strikes for all the stocks that made our list that particular month. And I sold out of the money, or I didn't actually sell them, but I made this spreadsheet where I put down how much you could make for your initial time value profit and what the potential was if we sold an out-of-the-money strike. So the column on the right side, the RU column, return on your option, averaged out to 2.1%. These are Dow 30 stocks, 1-month options, multiplied by 12 to annualize. 2.1% was the average. Now, the annualized return was 25%. Now, if we look at the upside potential, if the price of the stock moves from current market value up to the strike price, that represented an additional average of 1.1%, 13.5% annualized. So in the perfect world, which we never have, but it just goes to show the potential here, you can have, with these particular stocks, if everything went perfect, 38.5%. But we're not in a perfect world. But I'm willing to bet that everybody here in this audience right now would settle for half of that on an annualized return. I'm willing to bet that. Because you're conservative investors, you're not looking to hit a grand slam home run. You're looking to hit singles and doubles. So we do a comparison chart with the S&P 500, and we choose for the S&P 500. We talked about the select sector spiders. We like to choose the top 3 performing. You could do 2, you could do 4, but the top ones. So you will, in essence, own the top percentage of stocks, performing stocks in the S&P 500. Now, earnings reports for ETFs are not a factor. They don't report earnings. But there are ex-dividend dates, so you have to look at that the way I described before. Now, here's what a typical chart would look like. At this point in time, the S&P at the bottom was up 5%. This is a 3-month time frame. XLE Energy, XLB, and XLK were up 7, 8, and 10% respectively. So these were all, what this shows is the institutional investors, the big boys, were favoring these sectors at that point in time. So if they're favoring them, so am I. Okay, because these are the guys that actually move the price of the stocks. So you could have a portfolio of those 3 securities. Now, could we make money with these? I told you the returns are going to be lower because they're baskets of stocks. But you still can make significant money. So we sold out of the money strikes just for comparison. And the average initial 1-month time frame for the 1 month was 1.13%. And the upside potential averaged to 1% for these securities. So the 1-month return, perfect world, added up 2.1, which was 25% annualized. Now, you're not going to get 25% because it's not a perfect world. But you could get 15%, 18%, annualized using this strategy. And considering that what you can get on treasuries and CDs and money markets, that's pretty darn good. So yes, you can make money with Dow 30 stocks, and yes, you could make money with S&P 500 select sector spiders. Now, before we get to Q&A, I'm going to summarize for you, and then I'm going to talk to you about some of the products we have left over from my first presentation today. Then I'm going to show you a screenshot of the free resources on the website that you may want to take advantage of, and then I'll be happy to take questions. Covered call writing is an ultra-conservative strategy using the Dow 30 and S&P 500 stocks. I told you before that my preference in my portfolios for covered call writing are growth companies. For example, I use a lot of stocks from the IBD 50. These are growth companies with tremendous fundamentals and excellent charts. And I find great candidates in there. Plus, we have our own database of over 3,000 stocks that we screen for our members every single week. So I don't use Dow 30, but in my mom's portfolio, I do use ETFs. And I set a goal in mind for initial time value return of 2 to 4%. That keeps me out of trouble. It keeps me away from very risky stocks. And in my mom's more conservative portfolio, I bring it down to 1 to 2% with ETFs. So depending, one size doesn't fit all. What's right for me may not be right for you. What's right for the person sitting next to you may be the same, may be different from you. So you have to know what your personal risk tolerance is, set your goals, and then you'll know what kind of stocks to use. Should it be ETFs? And you should also know what options to use as well. The 3 required skills: stock selection, option selection, position management. Don't even think about investing 1 penny of your hard-earned money until you've mastered those 3 skills. Educate yourself. That's why you're here today. You're off to a good start. Paper trade, practice. Okay, I learned the hard way. My books weren't around back in the day. So I learned the hard way. I made mistakes and I corrected for it. I have a little bit of a knack for math. I created formulas. I built calculators. And it's become very second nature to me and thousands of people that are members of the BCI. So this is what I want for you. I want you to get from point A to point B without learning the hard way. Paper trade, practice a little bit, and now you're ready to benefit from these strategies for years and decades to come. The average retail investor that has little or no experience with covered call writing will need about 3 to 4 months to actually have the knowledge to get started in a very safe way. You could start out with a smaller portfolio, a more conservative portfolio, and then as time goes on and you're getting better and better and better at it, build up your portfolio, start becoming a little bit more aggressive but still conservative, and you should beat the market every single year, and here's why. When we sell an option against shares that we own, we are lowering our cost basis. This is not rocket science. So if we bought a stock at 48 and sold the 50 call for $1.50, our break even is $46.50. Our next door neighbor that bought the stock at 48 and didn't sell the option, his break even is 48. So we are capping the top, but the reason we're capping the top is because we're lowering our cost basis and we're increasing the opportunities to generate a positive cash flow. There's never been a year, I'll get to questions in a second. There has never been a year, I'm going to get to questions in a second. There's never been a year that I haven't beaten the market by using this strategy. Now sometimes I incorporate put selling into the strategy, but for right now, the place to start, if you're going to use options, and I feel very strongly about this, is covered call writing. Now, we have some products left. You can order whatever you want. We'll ship it for free if we run out. Our main package consists of 4 books. I have the #1 book on Amazon on covered call writing, the complete encyclopedia. The #1 book on Amazon on put selling, selling cash secured puts. I have volume 2 of the complete encyclopedia, and I have covered call writing alternative strategies for those of you who want to use the collar strategy, the poor man's covered call, or portfolio overwriting, stocks in your portfolio that you've owned for a long time. So those are the 3 strategies in that book. It includes also 3 streaming DVD programs with 3 downloadable workbooks and a month of membership, $329. That's a big discount off our web price. You can order things individually. If we run out, place your order. We'll ship it for free as long as you live within the United States on Monday. And this gives you a look. This is volume 2 of the complete encyclopedia. Now, the one book we have that's not part of the package, let me quickly mention it. This is my pride and joy, ladies and gentlemen. Stock Investing for Students. Once I got somewhat well known, I wrote the book that I always wanted to write. It's just finance, general finance. It's being used in several colleges now throughout the United States. It's not options, but if you're not near retirement, or if you have a son or a child or a grandchild that you want to get into finance, this is the book for them. We're offering it at a discount from 25 to 20. It's not part of the entire package of 4 books, 3 DVDs, and the free month of membership. So this is $20. So $329. You get the student book, $349. That's what we have in the back. I don't know how many we have left, but we'll ship it for free if we run out. This is my Selling Cash Secured books, puts, covered call writing alternative strategies. If you want to become a member for our annual membership for the next week, we're offering a $100 discount. You have to do that yourself online. Just go to the membership link of our website, thebluecollarinvestor.com. Put in SF100 and you'll get $100 off our membership. I think it'll be $469 with the $100 discount. That gets you 13 months of membership. Free stuff on my website, ladies and gentlemen. Number 1 is a Google search tool. If you, I've written about 450 articles related to option selling. If you have a particular topic you're interested in, put it in that Google search tool, and all the articles I've written on that topic will come up. Number 2 is a glossary I wrote. You may want to bookmark that. Number 3, free resources. That's where you get a free copy of the Ellman Calculator on covered call writing. There's also a single column put calculator that I created at that link too, along with about 10 other files. So all that's free. You just put your name and email address in there and you can access and download all those free tools. The Ask Alan videos and the free training videos. Over the years, I've made 165 and counting Ask Alan videos responding to member questions that I create a video about 10, 15 minutes, PowerPoint format, and they're all educational in nature. We put about a dozen of them on the website for free, and the whole library of 165 is available only to our premium members. So that's another member perk. And we add one every month. We also have about 12 webinars on our member site as well. Okay, and let me go right to Beginner's Corner 7, and in that little triangle at the top right there. That's like the Cliff Notes we used to use in college when we didn't want to read the books. So it's like an overview of covered call writing and put selling, all the aspects of it. You could download the PowerPoint for free. So it's not the detail that my books and DVDs have, but it's like an overview. So you could just log into that, put in your name and email, get in, do the first 2 or 3 or whatever, come back, do it however you want. You'll have access to 2 8-part video tutorials. Now, I write a newsletter every single week. I put a lot of time and effort into it. They involve charts and graphs. They all have an educational component to them. You can access that for free by going to the blog link of my website and filling in that yellow field there. Or you could just put your name and email in that form in the back, by the table in the back, and we'll be happy to put you on our list. And you'll receive the newsletter for free every Sunday morning, 10 a.m. Eastern Time. Okay, so that concludes my presentation. I'm happy to respond to any questions. Yeah, I think you may have to come up to that microphone so everybody can hear you. You know, there's a bright light in my eye, so I can barely see.
You mentioned lowering the basis, but that's technically not true, right? There's no place in the taxes to reduce it for your long-term gain. Your tax is the short-term rate.
The question is, you're not really lowering your cost basis. Well, if you bought a stock at 48 and it went to 0, you've lost $48. But if you buy a stock and sell an option for $1.50, the worst that can happen is you're going to lose $46.50. So frame it however you're comfortable framing it, but your break even, if you want to call it break even, I'm good with that too, is lower when you sell that option because you have a debit when you buy the stock and you have a credit when you sell the option. Now let me just bring this into the world of puts for a moment. When we sell a put, If we bought a stock at 48 and the broker would want us to pay $48 for that, unless we had a margin account. You know, a cash account, we pay 48. But if we sell a put agreeing to buy the stock at a certain price, let's say the stock is 46 and we sold the 45 put for $2, the broker will require us to put $43 per share into the account. So that becomes our break even. So if you're not comfortable saying lowering your cost basis, perhaps you'll be more comfortable saying lowering your break even.